According to the famous quote from Benjamin Franklin, this guy, two things in life are unavoidable: death and taxes. But do you know that billionaires in the US pay on average 8.2% federal tax on their income? That's lower than the lowest tax bracket available, which is 10%. So, how do you maximize your taxes? Today, I'll teach you multiple ways to deduct, defer, and get exemptions for your taxes. Hi, I'm Prudence, CPA and financial planner. This episode talks about strategies to reduce taxes and accelerate wealth accumulation. I'll review some key concepts and use a case study to tie it all together in the end. Let's start with the basics. The US government wants to promote jobs and long-term economic growth. So, they have many tax policies to incentivize people to do activities that would boost the economy, such as employment, retirement, healthcare, and education. And there are many tax-advantaged accounts you can use to lower your taxes and get exemptions. You'd be missing out if you are not using at least 3 of those accounts. There are mainly 2 kinds of tax-advantaged accounts: spending accounts and savings accounts. Spending accounts are straightforward. They are primarily flexible spending accounts, or FSA. You can contribute to the accounts with pre-tax money, meaning you don't have to pay tax on the money you put in to the accounts. And the funds can be used for healthcare, commute, parking, dependent care, and adoption. So if you contribute $5,000 a year to your dependent care account, for example, and your marginal tax is 20%, you'd be saving $1,000 on taxes that year. However, in principle, FSA funds must be used by the participant within the FSA's plan year, and you can only carry over a small portion to the following year. So if you have excessive unused funds by the end of the year, you will lose the balance that exceeds the allowed carryover. That makes it critical not to overcontribute and adjust your contribution ahead of time when your cost decreases. On the other hand, savings accounts do carry over from year to year. You can also invest with tax benefits. I put those accounts into 2 categories: pre-tax and after-tax. Commonly used pre-tax accounts are 401k and traditional IRA. That means your contribution lowers your income tax for that year. However, when you take money from those pre-tax retirement accounts, you will pay ordinary income tax on the distribution. It's also important to know that early withdrawal outside specific exceptions before age 59.5 is subject to a 10% penalty. After-tax means you must pay taxes on your income and then contribute with your after-tax money. Good examples are Roth 401k, Roth IRA, and custodial IRA for minors. The benefit is that you pay income tax now and the money would grow tax-exempt, meaning capital gain and future distributions will be tax-free. So with your after-tax account, it would make sense to invest in highly appreciating assets, such as high-growth stocks. Those accounts usually have contribution limits and withdrawal restrictions. So I use the vertical axis to show the level of access those accounts provide. The lower they are on the chart, the lower the contribution limit, and the more restrictive the withdrawal requirements. And if they are high on the chart, they are relatively more accessible or have higher contribution limits. Among pre-tax retirement accounts, from top to bottom are 457 for state and local governments, solo 401k and SEP IRA for self-employed and small businesses, 401a for government agencies, educational institutions, and nonprofit organizations, 401k for private companies, 403b for schools, churches, and other tax-exempt organizations, simple IRA for self-employed, and traditional IRA for people making less than a certain adjusted gross income. You might have noticed that Roth IRA ranks much higher than all other accounts on Access, and that's because it allows withdrawal of the contribution portion tax-free and penalty-free at any time. Whereas traditional IRA ranks pretty low on Access, and that's because not only it has a $6,000 contribution limit per year for people under 50 years old, It also phases out starting at $68,000 adjusted gross income or AGI for single and $109,000 AGI for couples. And if your AGI is higher, the amount you'd be able to contribute would decrease. If your AGI is more than $78,000 single or $129,000 as a couple, you will no longer be able to contribute. My younger clients often ask me, should I contribute to a pre-tax account or after-tax account? Well, it depends on your current marginal tax and your expected future tax bracket in the time of distribution. If your tax is high right now, it makes sense to defer tax and use a pre-tax account such as 401k. But if your tax bracket is low, it makes sense to use an after-tax account such as Roth 401k. And the rule of thumb is 25% for your combined marginal federal and state taxes. So that means in most states, if you're making over $55,000 a year and filing as single, or making $110,000 and filing as married couple, you're likely to benefit from deferring your taxes and using a pre-tax account. One excellent account you should also consider is HSA, Health Savings Account, because it has triple tax advantage. The contribution is pre-tax, lowering your tax income, and the investment portion grows tax-free, and you can immediately use the fund on healthcare costs penalty-free. And once you reach age 65, you can use it for anything without penalty. With rising healthcare costs in the US, I think everyone with a high deductible plan should max out their HSA contribution annually and invest long-term to benefit from compounded returns tax-free. Coverdell Education Savings Account is for education and provides tax-free growth. And 529 Education Savings Accounts are also after-tax accounts. But every state has its own rules and contribution limit. I'll put a link to a summary of all of the tax-advantaged accounts mentioned today in the description below. Please share in the comment which ones you are using and how your experience has been so far. To summarize, you can use pre-tax accounts to defer and decrease your tax liabilities such as FSA, HSA, and 401k. You can also use after-tax accounts to get tax exemptions and grow your money tax-free. If you could afford it, it's in your interest to contribute to the amount you would use in FSA and max out all savings accounts for compounded returns. Now, let's look at an example. Sarah and Prudence are single professionals working in Chicago, Illinois, making $80,000 a year. Sarah contributes 3% to her 401k to get the company match and uses no other tax-advantaged accounts. As a result, her taxable income after standard deduction is $64,650. Her federal tax liability is $9,800 and state tax liability $3,700. On the other hand, Prudence maxes out her 401k and HSA contribution. She also puts aside $100 a month for public transit and $150 for parking. You know how expensive parkings get in downtown Chicago. Her taxable income would be $39,900 and federal tax liability $4,600 and state tax $2,500. Compared to Sarah, whose marginal tax is 22% federal and 4.95% state, Prudence would save a total of on taxes. You might say, but then Prudence after-tax income would be $1,300 less than Sarah, even after the FSA reimbursements, because she contributed so much to her 401k. In our next episode, I'll share how I saved $1,400 a month on rent living in Chicago. So stay tuned. I hope those tips will help you lower your next tax bill. So if you liked this episode, please give it a thumbs up and share it with others. And if you want to learn more strategies to build your financial success, please subscribe to my channel. See you next time.